Hi, good afternoon, ladies and gentlemen. So sorry for the technical issue earlier on Facebook. We have trouble connecting to Facebook. Therefore, we actually direct everyone to Zoom. So welcome again to the market outlook of reviewing your portfolio, keep or sell the stocks. So many investors have stock in their portfolio which are seeing heavy losses, but selling them off at the current levels can be painful. So we do need to take a hard look at our investment portfolio and make difficult choices for better gains in the future. So today we are pleased with us today, the speaker, Mr. Terence Wong, CEO of Azu Capital, who he will tell you how he can actually provide some details on the current market outlook and also providing some complimentary review of the portfolio. So without further ado, may I please welcome Mr. Terence Wong. Hi, Terence.
Hi there, I'm just about to get started. Let me try to power this thing up right now. So, sorry, I faced a little bit of a technical issue myself, but it's a very small one. Okay, I'm going to start to share the screen. Hang on, let me just power this up. Can you all see it?
Yeah, yes, we can see it.
Can see, right?
Yep.
All right, I'm finally good to go. A good afternoon, everybody. Happy lunchtime. Very, very sorry for all the technical issues we faced earlier on. But anyway, I think that has been, all the kinks have been resolved. Want to welcome everybody back here again together with me. Always a pleasure coming back to listen to or like give talks to SIAS members. Something very, very close to my heart. Last talk I did say that, I basically grew up professionally with SIAS. I spent like 4 very, very good years here between 03 and 07. And during those heady days in 2004, 2005, when the markets were very, very buoyant, people are starting to look at the Singapore market. I started this thing called the Investment Discussion Group. At that point in time, investors, I'll have like a small group of people, 7 to 10 people. We will discuss about their portfolio because they happen to buy stocks, right? And many of them are Singapore stocks, which I'm familiar with. So they'll ask me, hey, what do I do with this? What do I do with that? Well, it was less so a portfolio discussion that, stock by stock, whether you should start to keep this or whether you should discard it altogether because the prospects are just not great. Fast forward 15 years later, today, remember 2020 has been a very, very challenging year, extremely atypical. And we thought that the markets will crash. It did come off significantly. And we did think that, interest will be like thrown out the window. But amazingly, in April, in May, during the circuit breaker days, a lot of the accounts were being opened on the SGX. And if you were to look at the major brokers here, whether it's like Philip, DBS, UOB KN, not so much DBS don't do it. So UOB KN, SPC, all of them have been reporting that CDP opening of accounts have seen one of the near peaks, like one of a record they never seen like in many, many years. And it took people about 2 to 3 weeks to actually start a CDP account. During that period, I think a lot of people are home, they don't have very much to do, so they start to trade and they start to look at their portfolio. Immediately after the circuit breaker, sometime in June, going to July, I do see a stream of people, some people coming to ask me, hey, what do I do with my portfolio? I haven't seen my portfolio for ages, but during the circuit breaker days, really nothing to do, right? So there's only like that much TV, that much Netflix you can do. that much food you can feed your dogs, right? And then your kids, you're giving tuition, like you're pulling your hair. So they end up looking at their portfolio, and they realize that there's a lot of things that they don't understand in there, and they end up coming to me. I don't do this professionally. I mean, I run funds, and it's commingled. So this is really outside my scope. But after looking through some of the portfolios, I realized that in 2020, as we stand today, it looked no different from what happened in 2005. Many people still, I observed that many people still have some lessons to learn when it comes to portfolio management. And that's when I approached Mr. Gerald. Mr. Gerald, I think that perhaps it is a good time to really engage the members again, to just give them a spiel of some of the more basic, some preliminary, I won't say knowledge, but really like to arm them, to prepare them to actually manage and look at their own portfolio. I cannot do for all, but today I will have a little bit of a surprise towards the end for members. But I cannot look at all your portfolios. It really takes quite a fair bit of time. And like I stress again, this is not what I do, but it's really out of a genuine concern for members. Many of them have seen me grow up professionally, and therefore I think that this is something that I'm happy to work on. Maybe just give you some tips, not on stocks, but on more on portfolio management. Like I said, I've seen the portfolio of some of the people over the last 4 or 5 months. People have come over to show me some things, or over lunch they'll just be talking about it. These are some of the observations I have, and I think that many people can possibly identify with it. Even the family members, when I look at it, it's there are certain common DNAs when it comes to their portfolio. So these are some key observations. Some people, they just have, actually many of us, we have a lot of stocks on our portfolio. Too many. I've seen 50. I think the record I saw was 78. So there's like massive number. Of course, there's some with smaller, but many of them come with many stocks that they've kept over 30 years. It's like that time capsule, like certain things, certain stocks, I know exactly when they bought it. And many of these companies, they tend to be very small holdings. They may have a million, 1.5 million, in their portfolio, but there are many stocks out there that they end up having 1-2 lots. They can't remember when they bought it. 1-2 lots, they may have bought it at $1, right? Then it's $1,000-$2,000. But these guys, over time, gravity sets in. Of course, you don't want that to happen, but very often, gravity will set in on stocks that don't really have very much prospects. It may have fallen like 90%. It may be worth a cent right now. So your one lot, a cent, is $10. Then you also don't want what to do with it. You throw away. The cost of throwing it away or discarding it is, the brokerage fee may even be more than what you are doing or discarding away, so you end up keeping, right? And you end up keeping a lot of that. Many of these stocks that I see on the portfolio, and it's just for one person, but across practically many retail, well, let's say all, but then most retail investors would have some war stories that they are gunning for some short-term funds, but they end up being long-term investments. Well, not really investments if you don't really care about it, right? So they end up keeping it all the way through. As I mentioned earlier on, they are hot stocks from way past. So certain stocks, I look at it, I know roughly when you bought it. I say, so this one, Jettison, I say, hey, I think you bought it in April 2017, right? Because through the 2 decades, this stock has been very, very quiet, unless you are quietly accumulating the stocks, which I don't think that's happening. So, but it's been very quiet. Only when in April 2017, because a report was written on it, there were like 2 good months of the last 2 decades that this stock started to surge. And I could bet my bottom dollar that this retiree, he bought it during those heavy 2 months, right? When the stock price, I think, went up by 3-4 times. And they probably didn't buy in at the low. Low was maybe 3-4 cents, right? It went up to 12-13 cents. Possibly they went all the way to 10-12 cents when they bought it. And I think that's when the beginning of the end. Many people will get in at the top, and then when you start to lose money, you start to lose interest. It goes down by 10%, 20%. Go, hey, like that, never mind. Like keep. I wait a little bit longer. But you wait a bit longer, most probably you forget. Or as it goes down deeper, you want to wait a little even longer to wait for it to like chong back up, right? But more often than not, it doesn't happen. A lot of times I know you get boiled over because when the volume start to set in, the brokers will start to call you. Wow, the brokers, they are just eyeing for really hot stocks, right? So when they see a hot stock, they think that it's an opportunity for you to get in, get out. They'll call you, Mr. Tan. Wow, Jason Chong, today, 30%, 2 days. You buy some lah, right? And you end up getting it. But unfortunately, like I say, it's the high end, it's towards the top, it's very topish. And that's when these guys start to call you, it's typically the beginning of the end. Some guys also have very concentrated portfolios that or concentrated not portfolios but they're concentrated in some a few sectors that they're familiar with, like this person, she was buying up the banks and account for 40-50% of their portfolio, all three banks, DBS, OCBC, UOB. So it ended up that the portfolio was typically concentrated. So this is the other end. She may have a lot of, like small stocks. And then there's another pool where it's very concentrated. So there are different people with different, I wouldn't say strategies, but then when they start to buy up, they don't realize that, hey, suddenly you've got 40-50% of your money in one particular sector. You're just basically buying the whole sector. And some people, the unfortunate ones, they will have like 1-2 counters that's been suspended over the last 10, 11 years. There have been many counters, that have fallen on the wayside and they've been suspended. Like I say, unfortunately, some people have been caught because they're invested in one-time wonder stocks. I see like a couple of investors, China Hong Sing, like feature prominently over there. This guy was delisted. This guy has been suspended for a long while. I think chances are it's going to be delisted. So they probably bought it, either way back in 06, 07 when the stock was like $2, or there was another opportunity, I believe in 2010, when it started to hit back up, like double from like 12 cents to 24 cents. A lot of people, I think, piled in at that point in time, bought it, and shortly after it was suspended for years. So I think that some of the lessons that investors can learn from all these, I think, unfortunate events, and we are always constantly learning. For myself too, right? When we build a fund, we invest in our money in funds, I'm constantly learning. But what I do take note of is that we do have to have periodic review at least. It could be a month, it could be a quarter, where you look at the stock, you take a hard look at the stock, and you do some form of spring cleaning. So before it starts to hit south all the way down to, like, say, from $1 to 1 cent, maybe by the time it hit 70, 60 cents, you're actually like reviewing the stock. You're trying to understand what it's doing, and you think that the initial thesis why you bought the stock is already like thrown out the window, then you may have to take the hard decision to cut loss at that point in time. Losing 30% is better than losing 90%, right? And you do this through gathering of updates. And now with the democratization of information over the internet, there's so much things out there, right? I mean, sometimes there's information overload. You don't, you probably are in a way better position than investors back in 1990s into the year 2000, where there's still like an information gap. People in the know will have significant advantage compared to people that are just trying to understand the company. But now, like I said, information is just about everywhere. It's whether you know how to capture it, whether you want to spend the time to capture it. Of course, diversification is good. You learn that in textbooks, but you probably want to over diversify. By over diversify, I mean you go back to the initial slide where I was showing you people buying 1 to 2 lots. You have like 50 of them, and many of them, because you don't even understand what it does, you don't do a portfolio review, and it start to come off, and before you know it, it will have already like dumped down, and you will lose interest in it because it doesn't make economic sense to actually like even try to sell it off. Right? This is, I think, very, very key, knowing what you're buying into. Most of the time when I ask, well, people, hey, you know what this company does, they wouldn't know. Like I said, it's because of a brokerage recommendation, or hear it over the media, over the internet, saying, well, this stock is very good. But there are a lot of self-serving, I think, individuals out there over the internet, more so than any time like before this, right? So that's something to be very, very wary about. But try to pick the good things, or things that or things that will help you in your analysis. I've always said that the analyzing a stock can be very easy, or it can be totally complicated. But I feel that most of us, we still need to arm ourselves with some form of basic ways of analyzing stock and looking at it. An important thing is that a lot of people, they just bank on analyst reports. I was an analyst for 15 years, right? 15, 16 years. And I'm the first to tell you that you shouldn't trust analyst reports. At least don't trust them 100%. Because analyst reports, sometimes they can, not be independent. You know that analysts, after all, many of us, we work at the sell side brokerages. So very often you don't want to antagonize the corporates, because you may want potential deals, right? And therefore, if you look at the buy and sell cost, the ratio is often very, very skewed towards the buy. Things have improved though. Things have improved tremendously over time, but still, I think that there's still bias when it comes to recommendations. And also sometimes because the analysts, they've been recommending the stock when it was like $2, but when it falls to 150, then off right, start to say it sell. So many of the analysts will just go, okay, it's even cheaper. I want to get it now. But then as it 150, it falls to $1, then they go, oh, it's extremely cheap. Then what do? Many of us are caught at the $2 level, right? And for them, it is really the valuation speak. The valuations suggest that it is not expensive. So as it goes down at every level, the propensity to switch costs will make them look very, very high. Will make them look very ugly, like they don't consider the prices falling. So that is something that I think investors have to look at. And then I know that many of you go, well, time, it's so difficult. But I think you just invest a little bit of time, and there are a lot of classes. I just have great, over the years, they have great programs involving the investment clinics, investment talks. They were essentially the pioneers. They've educated or done seminars for over 170,000 people, right? I'm no longer like in SIAS, the company doing research, but yet I look from afar, and I think that they continue to do very, very well with a lot of these courses. So take advantage of the courses. They are I think they are heavily subsidized. They are great value for money. Back when I did investment clinics with SIAS, it's very, very, I thought that the program was great because it's 3 hours every week for 6 weeks. And the thing is, you learn fundamental analysis. At least understand, like I said, when you want to invest in a company, you at least understand what the company does, right? That's the bare minimum. And then if you're confident of the prospects of the company, then you go down to when looking at the valuations of the company to see whether is it cheap or is it expensive. This part, I say, okay, you can look at analyst reports, because valuations, of course, that varies. You want to have a semblance of how much this company is worth. So it involves forecast, and then the analyst coming up with either discounted cash flow methodology or PE valuation. I don't bore you with the details. This one you have can get it off. I think that there are classes and courses for this, but as I said, if you want to put in very good money, just do a little bit of homework. We buy television, we go and buy a phone, we also do some basic research, right? And we also like try to listen out to see where we can get the best use. Same for stocks, right? And I think that it is also very important. I know that it is more difficult for retail investors to do, but there are still opportunities to do it. You want to like at least have to understand where the management philosophy, because I always believe that the management teams are the ones that drive the company, and therefore it is very, very important to understand where they come from, and there are a lot of opportunity to do so. Again, I think SIAS is a pioneer. We went out back on SIAS research. I think that we were one of the first to allow you to physically meet up with management of listed companies. We have seminars, and within the seminars, we have management teams, the CEO, CFOs coming down to explain the business to you. And then after that, you have a makan and mingling session. So I think that those are very, very important. I think ultimately it is understanding. If you want to like come up with a portfolio, you have to first take a step back and try to understand where you come from. There are a lot of I think that we got to focus a lot on the risk, whether you are willing and you are able to take risk, because that is a great starting point. That would also determine the kind of like returns, because it's basically risk returns, right? They always say risk return. So if you are able to take more risk, the returns will be more generous. And I think that investors who are younger, they can afford more risk. This is general, but it doesn't mean that all young people, you look at young people, you can easily take risk, and if you're old, you cannot take risk. It is also a function of how willing you are, because some people may have very, very deep pockets. So even if you're old, you are able to take risk on your own portfolio because you have already a humongous savings out there. You can take care of posterity for generations ahead. But in general, I mean, like I said, the young, you are more able to take risks, and you can get your returns can be a little bit more juiced up. We can like carve out more tech names, manufacturing companies, where they can trade with the P multiples, property companies, because that rides with the booms and busts of the economy. As you're older, in general, I know many of the investors here with SIAS, we've grown up with SIAS. And I think to their credit, they've also gotten young ones. But then many of the investors that have been on board with SIAS have been there for years, right? So many of them are into retirement. You probably can be a little bit more risk averse. But unfortunately, your broker is not going to think that way, When the market is, like say, very good, or one particular search very good, they're not going to think that they're going to look after your portfolio. They don't even know what you have in your portfolio, right? Very often they just want to make the trade. So they'll just tell you about this stock that's going up right now, that's like chonging. So they'll tend to ask you to buy, and then then that's where you start to build up on a lot of different companies that may not be aligned with the kind of your risk profile. As you get older, you want it to be safer, and that's where you take on the banks, the telcos, the REITs. Safer alternatives would be some people put in bond funds. I've got an alternative product a lot of people have been asking me about, because recently it was on Business Times, and I think that another another media group will be picking up on this particular fund. I think it's very, very interesting. Azure Light Fund, we give out, and this is only for accredited investors. But I feel that it can give anywhere north of 6-7% in terms of use, and it's very safe. The important thing is when you are older, you need to look for a safer product, and this is one of the very few. In fact, this was I put it on Facebook, and I've like spoken to the media group that covered it. that this is the only product that I would recommend to my grandmother, and I've ever actually recommended to my grandmother. So this is extremely safe. But like I said, it is only for accredited investors. What we do is we advise commissions to agents for work already done. But all these commissions are actually like backed by the agencies. If you look at it from property agency, in terms of say ERA, we give commissions to the agents because the agents take 6 to 9 months to collect their money. But by the time it hits month 3, the default rate is 0%. It is very, very safe. So we come in where the default rate is next to nothing. We advance the commissions to them, just wait for developers to pay the agency and the agency to pay us. And all the risks will actually be borne by the agency. So I think that products like this can give you an extra kicker and yet be safe at the same time. So in terms of your portfolio, what you should really be doing instead, like I said, you should do a constant review. You look at your portfolio. There are many companies that I think like is off the radar already. It's like come out significantly. Things like that. Time to shave off these stats. It may be very, very painful. You go, oh, it dropped 60-70% weightage. Killing off these positions. A bit sayang, right? So I think the best thing is you look for companies that you want to invest in, good companies, or you want to build up on the existing portfolio. So some of the companies may only be 2-3%, but it's good, right? So you start to shave down on the companies that's not so good, and then you reinvest and switch it into companies that you think are promising. This one makes it less painful to actually like let go of your current to let go of some of your positions which have fallen significantly. Then you're buying hope, right? That this company, that's a good company, you're just putting more eggs into this basket and making it a lot more concentrated so that you can get the extra, like say, extra juice. In many cases also, try not to over diversify. This is something that I indicated earlier on. I want to reiterate. You don't need to end up buying the entire sector, because then if you want to buy the entire sector, you just need to look at the ETF for that particular, or you just can look at ETF if you want to buy the STI, right? So try not to be overcrowded on one particular sector. You can, unless you are really, really excited about it. I know people that have been like asking me about the glove makers, and those that entered in April and put a considerable sum, I think they will have totally outperformed the market. I mentioned earlier on, in 2005, I started an investment discussion group with small group. I have like a few small group, 8 to 10 people, discuss about the portfolio. And then I also did the investment clinics, like how to invest in stocks. Right now, I think the people that are listening up, I have come up with something that I would like to introduce only to the SIAS members. I will look through your portfolio, but let's caveat, I can only look through a few. Me and my colleague David, he's also a CFA charter holder. He looks at a lot of these. He also understands a lot about the local market. What I want to do is I try to I can't. It's not about saving people. It's trying to like put it on the right track, and I want to do it on a consistent basis. Perhaps every month I can do 3 to 5, because this is really what I do is really pro bono. It's not that I'm gonna charge you for it, but I do like to look at some of the portfolio and I see how it can assist you. Maybe it's really I think in not great shape. That's when we can come in and we can try to tell you, oh, this is what you do. But a very, very big disclaimer, since I'm doing it at a company level, I'm not like doing it personally. If I do it at a company level, then I can only work on accredited investors. Again, this is important because I'm a licensed entity. Even though this is not part of my job scope, I manage funds and all. I don't look at personal portfolio, but still to advise them, I feel that if it is made out to be an advice, I think it's better to be safe than sorry. So I have to apologize. Only like accredited investors. So you can throw me your portfolio. We'll select a few every month. Whatever we can do, we will help you. And you can email it to this address, david.chow@azurecapital.com.sg. .sg. I will flash it out again later on. The thing is, I really want to, we really want to help as many people as possible. Perhaps like to not so much maybe to tell them about the stocks, though we will be advising them on certain stocks, why they should be keeping, why they should not be keeping. But I think more importantly is to handhold them and give them the right way of like investing. And I think that's key. And I hope to do this on a regular basis, like including a talk, so that I can showcase. I'm not going to say, oh, Mr. X, have all these things. But if I have more data, I can share, with you guys. That part you don't have to be accredited investor. You can be here and you can listen to the sharing. I'll tell you, like this is what we did, and the end results. Some of the things that we will look at is and David actually like scours through the whole portfolio and done that before for a couple of investors, and we will look at things like something that's fairly elaborate on your average dividend that you have in your portfolio, because I think most of you don't know, and you want to know what's your expected returns. We want to tell you that we suspect that this is your investment strategy, correct us if it's wrong, or you already have something in mind, but then it doesn't tally with your portfolio currently. So we also advise on the way you should allocate and whether your current portfolio is correlated with the market in any way, and what's the volatility, the risk that you have in this particular portfolio. Things like that I feel is very, very important. Or whether you are like too laden with REITs. Many people have been buying REITs, for a long while right now, and they've been accumulating REITs. It's not a bad strategy. It's just that, is that the kind of like returns that you want? These are things that I think we'll ask you. I think Mr. Gerald last time when I was with him, he said that these investment clinics, you're like the doctor. The patient comes over to you, to look for help with regards to their stock portfolio. I think that we hope to rehash something like that, do it on a consistent basis, and we try to like share ideas. Maybe in the future, like what I've done in the past is really to talk a bit more about the market. But I think at the onset, the get-go for this first time I'm talking about the portfolio management, I have been focused very, very much on what the problems, the issues, how investors can look at the issues, and how we can help investors look at the issues. So it's more, it takes a little bit of time, but in future, once we get some of the basics out of the way, we can also share more about the market outlook, and you can also ask me anything about the stocks on the stock market. If there's any other things, if you are keen, you can come over my Facebook. You like it, give it a like. I share with you. Remember earlier on I was telling you about the management. I am quite close to quite a few of the CEOs in town. I do have copy sessions with them. I think through my postings, you can get a little bit of gossip about them, and as well as snippets about the company. So I think that adds on to the way you can analyze the companies to see whether it is something that you want to invest in, right? I'll try to lend a different color regarding the founders and the CEOs of these listed companies. So with that, I think I can open the floor to some questions. Wait, let me see how I can. Stop sharing. Okay, the question I see, you can text me a question, or Julian, how else can they do it? I mean, I've done Zoom and most of them they just like ask me when they over this chat,
I
right?
think, if you have any questions for Terence, you can just type in the Q&A function, and Terence will actually just answer accordingly. So actually you can see one question here by this guy.
Okay, I can take on questions regarding portfolio management. I can take on questions regarding the market, what I think about it. I can take on questions about stocks in general, right? So we can use this platform for that. Again, just stress, don't need to be shy. Question, even as we send the portfolios to your colleague, will you be involved as well? Yes, definitely. So two of us will be looking at this. like I said, we will first sieve out those that we can look at, because right now it's not like friend, people coming over to me and I just help them scan the portfolio. This one is like kind of a more I think more formal basis, which is good. We look at the portfolio, and because we're a licensed entity, I need to stress it's only for accredited investors for now. Hopefully, as I grow, I can do retail investors as well. That's something that's very, very close to my heart. I grew up with you guys, and I've been giving talks, I've been recommending stocks all the way through for so many years, and I started on sales. So I really want to work on the retail crowd, the general crowd sometime. And what I want to do right now is to build up data points so I can do accredited investors because of also the manpower constraints. It takes quite a fair bit of time to look at that. What David and I will do is, like I said, we'll try to do like 3 to 5 a month first, and we'll see, and we get enough data points. I can share certain information to the general public so that they can learn from it. But I'm not going to say, like I said, I mentioned, I reiterate, this guy did this, right? I'll just do something general, but I hope that through that sharing, everybody gets to learn. Can you share experience with Civic Environment? Yeah, that's a counter I had. The stock was eventually privatized at lower than key firms' entry prices. Lesson learned. Um, I think that it was a series of I feel unfortunate events, right? Because at that point in time, the founder of Civic Environment, which is he's Dr. Lin, he was the owner, founder of the previous life form, which was United Environment. After he stepped down, there were a lot of rumors rolling around, that there were shenanigans, which was proven to be unfounded. Then subsequently, I think China plays were came off the radar. Then the water plays that in China, in Hong Kong, the valuations got whacked because one of the biggest water players also faced difficulties. And all in, like I said, it's a confluence of negative factors that brought the stock price down from, I think, 70 over cents to a low of 20 over cents, I think, at one point. But I think subsequently the company had to work very, very closely with some of the key guys. You're right, the key guys, some of the investors came in, I believe was in December. At the point in time, they came in at a high of close to 70 over 80 cents, and it was privatized at much lower. So sometimes I think bad things happen, and they couldn't control the macro environment, which affected the company, and therefore I think Civic was always like reported to come in to take it private. They picked the right opportunity, and I think sometimes the investors, especially retail investors, get the short end of the stick. Unfortunately, it seemed to be a good company, and it has a very, very strong SOE backing. The water industry in the mid to long term, I think, has always been a very, very strong contender. I think has been like an evergreen theme. But unfortunately, I think that at that point in time, the stock just didn't perform, and Civic came in strong and hard on this. Is your portfolio optimizer Excel file only available to those who sign up for the portfolio review? What Excel file? Okay, I see what you're talking about. The one that I showed you as an example. Yes, we will build up something like that for you. I think David will have to go through some rigors to actually build it up. So it's highly manual. Like I said, it's also outside our job scope, but we will, even though it's pro bono, we will not do any shortcut. So it is quite time consuming. Yes, and it will only be those that we currently pick. What's your outlook for the Singapore stock market going forward for next 6 months? Which sectors are you bullish and bearish on? Singapore stock market, if you're looking at it right now, because of the earnings revision lately, it is not exactly cheap. We're talking about 30 over times. But during a recession, this is what we expect. The PE will actually just spike up. If you look at 2009, for example, when there was a major recession, right? All the earnings start to come off, and therefore the market PE spike up. This time around, the spike is not as significant as what we saw in 2009 or 1998, for example. But nevertheless, I think that investors should still be fairly cautious. Unfortunately, the markets, I would say globally, but at the very least, in the likes of US, Taiwan, China to a small extent, all of them have run up significantly from the shock on the 23rd of March, when the whole world just went under, all the stock markets just went under. We are like maybe 12% up from there. Whereas in the US, most of the indices have already flirting with all-time highs. When Nasdaq's case, it is already in all-time high territory. So going ahead, I mean, in Singapore's context, I think one of the problems is we don't have that kind of like technology, the kind of like tech prowess to power the market. Many look at our STI, there's 30 stocks out there, possibly 50 to 60% of that 30 stocks, they are yield-driven. That's why our yields are very, very high. So we are a relatively safe market. Out of the 30, there's 6 REITs, 3 of the banks also give good yields. There's Singtel, and like I say, all of them we add is 50 to 60% market. So we are a safe market. I don't think that there's going to be a massive decline, but in the near term, I think it will be challenging to expect the markets to head up significantly. Because, and I think we also have to look at the macro environment. US right now is again recently running back on a high. And that's because, and they are listening up to a lot of what Donald Trump has to say. And should the elections not go the way that the market wants, and the elections are barely a month away, I think that there could be a possibility of a violent shock. Because, like I said, the markets are running on a high. They do have certain certain expectations. If it falls outside the expectations, markets will take a tumble. And Singapore, just like the economy, our stock market is also small and open. I think it will be susceptible to if the major markets were to take a tumble. Even though we didn't go up as much as them, we've just got a fraction of how they went up. But when they come off, we will also fall in sympathy. So that's something that I think investors have to look out for. Net recent UK acquisition was not viewed favorably. Okay. Net recent UK acquisition was not viewed favorably. Do you still have confidence in company's future capital allocation decisions? And are you still positive? I think sometime like even before COVID, I feel that because of the recession, what Net has is, I mean, it's one of the regions or Singapore's largest placement agency. It's done tremendously well. I mean, it was founded by Peterson back in 1993, 94. All through, they've not lost money, except I think 1 year in 1998. So he has been very, very prudent. And if you look at the cash is north of like $250, $300 million. It forms a big part of their entire market cap. It's run very prudently, and because of the way he has structured it, it has grown to be the number one in Singapore. I think a market share of say 20% thereabouts. But because the market has not been good at private market, I think that affected the stock. Even before COVID, that had a big impact on the stock. I think going forward, as people struggle to find jobs, they will take a little bit more time to recover from that. Is diversification necessary for long-term investing only or also for short mid-term trading? I think diversification is good like I said, but you don't try to over-diversify. And some people, they are not really over-diversified. They just don't know what they're buying and end up, they look like they have a very, very diversified portfolio. But diversification is really something that is by design. You want to like move on and capture uh, you want to move on and look at different sectors and different stocks so that should one particular sector or stock come off, it will not affect your overall portfolio returns significantly. So that's the basis of it. But I tend to take on a slightly more concentrated portfolio because if you have confidence in a particular stock, that's where you should put a higher weightage. So I wouldn't have like say 2%, maximum 2% across 50 stocks. Possibly some of the ones we have more confidence, we can put 5 to 10% of the money in there. I think I will just end off very soon because it's about time. Sure, text. So if you have any other questions, I think you can PM or email us separately. I'll be happy to answer your queries. That one you don't have to that one you don't have to worry. Once we take it in, we will be able to answer some of the questions. You can find us, like I said, you can email David, you can email me, or you can find me on Facebook. That's where you can ask some of the questions also. I'll take the last one, the random. Should tech stocks be in conservative portfolio focused on returns? Well, some of the tech, I mean, you've got to see. I mean, tech stocks they run on high, and your impression of tech stocks is that there is strong growth, but yet they may not be exactly same. So it runs a boom and bust. I don't know what the definition of tech stocks is. Some people may think, along the lines of a Tesla. Or Tesla, that I think is really a roller coaster ride. It's not suitable for, I think, a conservative portfolio. But if you're talking about, say, Apple, or in our context, in our local context, local tech manufacturing stocks, they are very, very steady. They do grow, but it's not those kind of like tremendous growth. But on the flip side, they also have a very, very conservative balance sheet. Venture, I think 15-16% of their entire, and I'm not recommending a stock, but then if you look at venture, there's like $800 million of cash. That's about 15% of their total market cap. They continue to generate cash and they continue to make money. So these are kind of like stocks that is likened to having the cake and eating it. You can ride the tech, right? Not exactly like the likes of Apple, Google, or Netflix, but then yet you have something that's safe out there that you can continue to give dividends. The dividends I think they're giving is about 3.5 to 4%. Right. So I think I will end off here. Like I said, any questions, you can just bounce it off to me. Thanks so much, everybody. I'm so sorry. There's still quite a few questions out there, but time has run out. Julian, over to you.
Right. Thank you, Terence, for sharing today's session. So for attendees who actually miss out the earlier part of the session, don't worry. We will actually put this recorded video up on Facebook sometime probably in the next couple of weeks. And we actually drop everyone an email to inform on this. So once again, so sorry about the earlier technical fault, and we hope that you have a good week ahead. Yeah. So once again, thank you, Terence.
Thanks so much.
Thank you, everyone.
Thanks, everybody at SIAS. Thanks, Julian. Thanks.
Thank you.
All right.
Bye-bye.
Bye-bye.
Bye.